And now Antonio Senatore from Cartesian Capital joins us for a closer look at what's playing itself out in that market scene. Antonio, thank you for your time and good afternoon.
Good afternoon.
All right, Antonio, not the best.
Last week.
Yeah. Please go ahead. I was going to say to you, it's not the best start to the week. If I look at just the JSE, even what we're seeing coming out of Europe, it's supposed to be a rebound, but it's hardly anything to write home about.
Yeah, it's very calm this morning. Last week, the volatility index dropped. Now the volatility index has dropped to around 20 after reaching 38.5 last Monday, following all that market turmoil that was caused by those disappointing non-farm payroll numbers. But despite relative calm returning to the market in the last couple of days, there is a big risk event on Wednesday. That's US CPI data that's set to be released. And the Fed now has to balance the risks of inflation and a weakening labor market. And I think whether they cut by 25 basis points or 50 basis points in September will really depend on the next two CPI prints. So the US interest rate market at the moment is pricing in a 52.5% chance of a 25 basis point cut in September and a 47% chance of a 50 basis point cut. What's interesting is that one of the Fed governors yesterday made a statement noting that she still sees upside risk for inflation and continued strength in the labor market, which indicates she might not be ready to support a September cut. So it seems like there's still some disagreement between the governors. So we will be paying close attention to Wednesday's CPI print because the market is very news sensitive at the moment.
And have US earnings to date given us any indications of how strong or weak that economy is?
So I think some earnings have been disappointing. It's very difficult to know the direction of travel at the moment. The tech stocks are at high PEs. The Nasdaq has a P of over 30 times. So any negative news can have significant downside implications. The market now is looking for those earnings to catch up to those to the price. So and they have been disappointing, especially in the tech sector. Which points to a weak economy, a weakening economy.
Encouraging for us to see here at home, Antonio, a decent brand, I think at 18.20 to the dollar. And of course, keen to get your thoughts on that and how it does play into the recessionary fears in the US.
So the rand, I think, at the moment is driven by dollar weakness. With all this recessionary fear last week. But another interesting thing is that CPI on Wednesday, if it comes in lower than expected, so the market is expecting 3%, I think if it comes in much lower than that, it will reignite these recession fears. The rand might strengthen on the back of that because the dollar will weaken.
Then let's get into some company news today. I think quite a bit of traffic coming out of the local market. Let's start off with Brait. They've met their rights offer target, 1.5 billion rand there. It looks like investors still believe in this holdco. Keen to get your thoughts on this one, Antonio. In my mind, I think outside of Premier, Brait is a struggling business.
Yeah, well, the rights issue was good. It was very successful, and they're going to use those proceeds to pay down debt and fortify the balance sheet, which is positive. Also, if I understood correctly, I think Virgin Active was looking to list a while ago. So yeah, not a company that I follow too closely.
But would you buy a Virgin Active stock?
On the ground, I've moved to Planet Fitness.
Okay.
So I'm not a fan of Virgin Active, but I'm not too sure.
Hashtag noted, Antonio. Let's talk about Sasol now. Very interesting here. Sasol, also a business that I think fundamentally is battling. We had received reports around some regulatory issues moving in their favor. But all in all, it looks like an earnings pledge of 77% or up to 77% is what we can anticipate from them. I'm not sure. What do we make of this?
The Sasol is being impacted by the chemical cycle. The EBITDA is expected to drop between 2 and 17%. HEPS, as you said, up to 77%. But what's happened here is that they've taken impairments of 75 billion rand, of which 59 billion rand of that is in the US operations, and the rest is in the South African fuels and base chemical assets. So the earnings per share look very weak because of these impairments. It's not really an operational loss, but the company is still operationally under pressure because of that chemical side, which has been under pressure. But the fuel side in South Africa is doing reasonably well. The oil section of the business was supported by a stronger rand oil price, and it's doing well.
Just speaking about those U.S. operations, that includes Lake Charles. I think maybe a while ago we spoke about Lake Charles and it might be completely in Sasol. We thought there was a recovery of sorts, but now we're back to seeing that business while under pressure.
Yeah, that's correct. That's it's been a challenge for them. It's always been a challenge, and it's a tough one.
Then let's talk about
the American side is a challenge.
Absolutely, absolutely agree there. Let's talk about Avenge. Also an interesting one there, of course, one of what used to be one of the big five construction companies. Not so much anymore, but they are eyeing a return back into the black. I think this industry is seeing some form of optimism again. What do we make of it?
So in the infrastructure, they're expecting positive performance in that segment. Operating earnings expected to reflect an improvement from the prior year, and the underlying business seems to be quite strong. They're seeing continued strong liquidity and cash flows. In the building segment, they're reporting increased revenue and improved operating earnings again to the prior year, and growth is in line with their agenda. The mining industry has been under pressure just globally. It's been a challenge. Global economic growth has been a challenge which has affected mining. So that sector is a challenge for them.
Then let's talk about Italtile. We just haven't seen that renovation, cycle turn up since post-COVID-19. Maybe if we see interest rate cuts, a company like Italtile may benefit. For now, though, still expecting lower year-end profit.
Yeah, so the point is that it's been a tough environment for the consumer, and that's affected each of their brands, which is Italtile, Top T, and CTM. But they're market leaders in each of those segments, and sales decreased by 2%. It's not that significant, but it provides a base from which, in an environment with improved market conditions, with lower interest rates, they could grow quite nicely. The challenge is ceramic industries, because ceramic industries is a manufacturer of tiles, and that depends on volumes. And there was lower volumes going through the factory, which affects the efficiency of the plant. And so it's quite important that they get these sale volumes through the factory, through the plant, because that leverages their economies of scale. So they need to utilize it fully to get those economies of scale.
Well, Antonio, let's get into our stock pick segment now, maybe starting off with counters that have found favor with industry peers.
So again, for Hoskins Consolidated, or HCI, I read through the annual report this week, and it's just once again a reminder of the underlying value in that business. So most of the viewers might be familiar with the traditional assets they have, like your Southern Sun and Sorgo, and small investments like eMedia, as well as Frontier. All of those assets we think are actually quite attractive. But of course, they've got the big impact oil and gas investments. That's specifically the basin there in Namibia. We think it's got enormous upside potential. And with the funding agreement now in place, with the farm out and so forth, we think buying Hoskins at these levels is, I wouldn't say no-brainer, but certainly for us, very enticing.
I'm going to say we are positive on MTN. And really, what you need to do as an investor is you need to distill your investment case down to 2 or 3 points. If your motivation is hinging on 10 or 20 things, it probably means you don't understand the business model well enough. And in the case of MTN, there are really kind of 2 or 2.5 things that are important. The first is that in Nigeria, which is half the business, they've renegotiated the tower leases from dollars to naira. And that obviously is essential because they earn naira. Now the naira has weakened from 400, 800 to 1600 versus the dollar. And having renegotiated those leases into local currency is essential. The other thing that they need to do, which they haven't quite yet done, is they need to get tariff increases in Nigeria.
So Shoprite came out last week as well and reported, despite having lower inflation, their like-for-like sales continue to grow, they continue to gain market share. So I'm hanging my hat on Shoprite. I think this promise of lower interest rates should help or should give some relief to the consumer. And that may, I don't think the shopper is going to shop up.
All right, Antonio, keen to get your thoughts on some of those. We've got Shoprite, MTN, and HCI.
Well, HCI, as we know, is a holding company, and those typically trade at a discount. A continuing challenge there is the intention of closing that discount. Currently, the blue sky there is in its energy assets in Namibia, but these will take many years to come to fruition. Still early days, and currently they need to renegotiate a coal supply contract with Eskom, which remains uncertain. But I agree that with patience, it's a good company to hold, and it has shown good deal-making capabilities. MTN, as he said, has renegotiated its tower contracts in Nigeria, which are USD-based, but now converted to Naira. Remember, its revenue is in Naira, so now expenses and revenue are more clearly matched. MTN Nigeria operationally grows strongly, but the Naira has had a substantial devaluation. So this new contract puts MTN in a much healthier position. Shoprite continues to gain market share among the food retailers. It now has significant scale and operational efficiencies. It continues to expand its various brands such as Checkers and Usave, and expands into liquor and pet stores as well, and more recently clothing with Unique. And its online delivery, Checkers 6060, it's now a household brand name. So it's the most solid retailer in the food sector, and it's rated as such by the market.
Well, that's it. Which counter are you loving today?
I'm going with Italtile. Didn't know they would come out with a trading statement, but I still going with it. So they previously benefited from the stay-at-home dynamic from the COVID pandemic, where people renovated their homes. Subsequently, building activity slowed as interest rates were raised, and the consumer came under spending pressure. But now we enter an interest rate cutting cycle. Italtile, as a dominant supplier of tiles and bathroom accessories, should benefit from that as the consumer comes back to support retailers. And I think it's well placed in that it services different LSM sectors through the different brands, as I mentioned earlier, like Italtile and CTM. And any increases in sales, as I mentioned earlier as well, will load their factories, resulting in improved manufacturing efficiencies. And another important aspect is that the company has an extremely strong balance sheet with cash on hand. It's got an ungeared balance sheet.
Well, thank you so much for your time today, Antonio, and getting the week going for us. That was your midday markets update with Cartesian Capital's Antonio Senatore.